Hi guys, welcome to this channel. I believe finance, science and psychology are the keys to better life. One step at a time, let's create a snowballing effect in our lives. I'll be at your service to research concepts and share them in simple and fun videos. If you find this video helpful, please press the like button and remember to subscribe. It will help me tremendously to grow this channel and keep me going. Before we start, it would be irresponsible not to declare that I'm not a financial advisor, and everything I share is just for learning and entertainment purpose. Now, as you could probably guess, it is a financial book this time called The Way of the Turtle by Curtis. We'll be sharing the following topics in this video, and I have prepared the timestamps for you guys. If you would like to jump to any section you're interested, please feel free to do so, but it will help this video to be found by others if you stay till the end. We'll be talking about the introduction, why does a financial book has anything to do with the turtles, and the turtle mind, 4 emotions and 8 cognitive biases. Third, the turtle age, what is a system age, and then the turtle trading system. It includes the market, position size, entry, stop, exit, tactic. And then we'll be talking about the risk and reward of the system, and lastly, how to test the system. The turtle program started as a bet between Richard Dennis and Bill Eckhart over whether trading can be taught or not. Richard was willing to stake his own money on the idea that trading can be taught. Richard published a full-page advertisement in a major newspaper to select 10 also traders, train them in his method, then gave each one of them $1 million of his own money to trade. He believes it is about the trader's ability to execute the trading system, and explains why 10 people with the same set of rules taught produce different results. The conclusion is that human beings take many shortcuts in their decision-making, and it makes them very inefficient. The author of the book, Curtis, is one of the trainees. Over 4.5 years, the turtles earned an average return of over 80% per year. You may ask, why are they named as turtles? Because the debate turns out seriously at a turtle farm in Singapore, and Richard said, we are going to raise traders like we raise turtles in Singapore. It may surprise people Richard thinks that he could teach a group of traders in only 2 weeks. If you are curious what we have learned now, let's rock and roll. Human emotions is both the source of the opportunity in trading and the great challenge. To trade well, we will need to understand the human mind. Why market phenomena and price actions affected by cognitive and psychological factors? People rarely make completely rational decisions. The 4 emotions. Hope. I hope the price will go up after I buy it. Fear. I can't make another loss. I will sit this one out. Greed. I'm making so much money, it is time to double my position. Despair. The trading system doesn't work. I keep losing money. Then we'll be talking about the 8 cognitive biases. Loss aversion. The tendency for people to avoid losses over gains. Imagine whether losing $100 is the same as gaining $100. Research suggested losses can have as much as twice the psychological power over gains. Sunk cost effect. The tendency to treat money that already been committed or spent as more valuable than the money that may be spent in the future. In business, this is the money cannot be recovered. Like investing in one technology, it may stop people from making rational decisions switching to a cheaper technology, whose cost-saving benefits may outweigh the investment. This makes people hard to exit a position during loss. Disposition effect. The tendency for investors to sell shares whose price is increasing and keep shares that have dropped in value. People not wanting to face the reality of a decision that has not worked out. Outcome bias. The tendency to judge a decision by its outcome rather than by the quality of the decision. Recency bias. The tendency to weigh recent data or experience more than earlier data. In trading, even a correct approach can result in losing trades. Perhaps a few in a row. 2 months of losing trades could count more than 6 months of winning trades that happened previously. Anchoring. The tendency to rely too heavily on available data. For example, when selling stocks, people may always compare with recent highs and struggle to sell. Herd effect. The tendency to believe in things because many others believe in it. Belief in lay of small numbers. The tendency to draw unjustified conclusions from too little information. A turtle never tries to predict market direction, but instead looks for indications that the market is in a particular state. Emotional and psychological strengths are the most important ingredients in successful trading. In the first year of trading, although found himself surprisingly the only one with full positions on one trade by following the same rules as everyone else. It also made him the best performer of the year. The turtles was taught how to think in terms of the long run when trading, and they are given a system with an edge. An edge refers to one's systematic advantage over an opponent. Elements for a system edge: portfolio selection. The algorithm selects which markets are valid for trading on a specific day. Entry signal, when to buy or sell to enter a trade. Exit signal, when to buy or sell to exit a trade. An edge can be quantified by analyzing a system's historical traits. The turtle views losses as the cost of doing business rather than an indication of a trade error or a bad decision. The call to trade is to capture every trend. 2 or 3 trades may account for all your profits, so don't miss a trend. You may go several years before finding a single good trend in some markets. Ironically, it seems that just about the time that everyone else gives up, trends appear and tend to be easy to ride and extremely profitable. You want to think the future in terms of possibilities and probabilities, rather than in terms of prediction. Successful trading includes the following elements. Markets, what to buy or sell. Market liquidity was the primary criteria used when determining which market to trade. Position size, how much to buy or sell. How much to buy or sell is fundamental. Proper diversification requires making similar, if not identical bets on many different instruments. The money management is more art than science, or perhaps more like religion than art. Turtle money management means staying in the game. The primary goal of trading should be stay in the game. Time is on your side. This can only happen if you can continue trading. Sometimes it does not matter where your stops has been, as the market could skip the stop overnight. If you only rely on the distance between the entry and the stop, you could end up losing a lot of money. You need to manage the position size as well. Position sizing. Volatility is represented by N. N is the 20-day exponential moving average of the true range. The true range is the maximum of either the three: the current high minus current low, the current high minus previous day's close, the previous day's close minus the current low. N is then calculated using the formula of adding up the previous 19 days previous day's N plus the current day's true range and divided by 20. The dollar volatility equals to N times the dollars per point, which is the share price or the contract price. The turtle built positions in pieces called unit. Their unit was sized so that 1 N represents 1% of the account equity. If you are more risk-averse, you could decrease the percent of account representing 1 N. We will see this in the following formula. Unit size equals to 1% of the account divided by dollar volatility that we calculated previously. It tells you how many units or shares you could purchase, allowing the price to oscillate for 1 N, which representing a 1% change of your account equity amount. If N of a stock is 0.2, your account size is 1 million and price per share is 100. Your unit size will be 0.01 times a million divided by 0.2 times 100, which equals to 500 shares or contracts. Purchasing 500 shares at the price of 100, if price changed by 0.2, your equity amount will change by 1%. There are some other limits. Single market could have a maximum unit of 4. Closely correlated market could have a maximum unit of 6. Loosely related market could have a maximum unit of 10. Single direction, long or short, could have a maximum unit of 12. Entries. When to buy or sell, the turtle mainly used the breakout system in simple terms when price exceeding high or low of a particular number of days. Turtle enters a single unit long position, for example, and they will add to those positions at half an interval after initial entry. If the market moves quickly, it is possible to add a maximum 4 units in a single day. We will see an example here. If N equals to 2 and our entry price is 30, the first unit is added at 30, and the second unit is added at 30 plus 0.5 times 2, which is 31. And third unit is added at 32, and fourth unit is added at 33, so on. Stops. When to get out of a losing position. Getting out of a losing position is crucial. The turtle decided no trade could incur more than 2% risk. As mentioned above, if 1N is equal to 1% of equity, the maximum stop will be 2N. Also, if additional units are added, the stops for earlier will raise by half N as well. Let's say an example here. If N equals to 2, first unit at 30, stop loss at 30 minus 2 times 2, which is 26, and second unit is 27, and third unit stop loss is 28, and fourth unit stop loss is 29. The stop price changes for all units together, not specific for each unit. For example, when the fourth unit is added, all 4 unit stop loss will be 29. If fourth unit is added with higher price like 35, then the stop should increase to 35 minus 2 times 2, which equals to 31. Prices never go straight up. It often can mean watching a decent profit of 10 to 30% fade to a small loss. The turtle use a 10-day low or high or 20-day low or high depending on the system they use. Tactics: how to buy or sell. The turtles were advised to use limit orders and it takes some skill to determine the best price for limit order. During fast-moving market conditions, the turtle were advised to wait for the market to stabilize before placing orders, or at least wait for a temporary price reversal before placing the orders. If there are more market entry signal generated, buy the strongest market and short the weakest market. The author advised the turtle rules are very difficult to follow because they depend on capturing relatively infrequent large trends. During those periods, it is easy to come up with reasons to dodge the system and stop following the rules. To marry a trading system, you need to understand the risk and the rewards of the system. For primary risks, drawdown. Series of losses reduce the capital in their trading account. People tend to overestimate their tolerance of losses. A prudent new trader should adjust his risk, though it means reducing returns. Author has experienced a worse drawdown on the order of 70%, which I found quite hard to take away myself. Let me know what your worst losses has been in the comment. Low returns. Periods of small gains in which one does not make enough money to make a leave. A system returns 30 every year is equivalent to a system returns 5% in year 1 and 2, but 100% in year 3. Third, price shocks. Sudden movements in one or more markets that result in a large uncoverable loss. It is usually caused by a natural catastrophe, unforeseen political event, or economic disaster. Anyone who wants to earn high returns is taking equally high risk. Lastly, system death. Market dynamic change that cause a profitable system to lose money. Since the markets are dynamic and are composed of many other participants, it is a reality that markets change, and this could affect the results of the system. How to measure the rewards? We use the compound annual growth rate, which reflects the rate of growth when compounded equally over a specific period. Average 1-year trailing return. This is the measure of the average return for a rolling 1-year period. It is less sensitive to a single period of high return. Average monthly return. It is the average of each single month. The strategies which historically appear to offer extremely good risk-reward ratios tend to be the ones that are the most widely adopted by the community, as you end up with large capitals chasing the same strategy, which outgrow the liquidity of the market. However, returns tend to be cyclic, as when there is huge new influx, markets cannot easily digest the amount of new money. Now we understand how to measure a trading system. Let's see what we should understand in testing a trading system. Some people don't believe in testing historical data because the past will not repeat itself. However, the only information you have is what the market has done so far, so it could still be a guide. There are 4 major sources of discrepancies traders often find between historical test results and when is encountered in actual trading. Trader effect. If a method has made a lot of money in the past, more likely that other traders will have noticed it and will start using similar ideas, which may result in his method not working as well as it did initially. Therefore, it is better to develop your own system. Random effect. The historical test may have demonstrated better results of purely random chance. Author tested the system, entering long or short, randomly on coin flip and prefix random time exit. The best test returns 16.9%, and the worst lost 20% per year, just to show how random events could impact your return. The author recommends investors to invest in people, not historical performance. As from a large sample, there will always be some lucky ones. Optimization paradox, the act of optimizing a particular parameter, for example, number of days to use for the moving average. The future will never be exactly like the past. It is still good to understand the effect of the optimization, but not necessarily means to choose the best result parameter for the past. Overfitting. The system could be tuned to historical data so closely, complicated that a slight alternation will produce massively different results. An example will be a root reduced position by 90% when reach drawdown of 38%. A good test for overfitting is by introducing a small change in parameter value, as this usually output a widely different result. Tactics. There are some tactics that we could use in testing our systems. A statistic is robust if changing a small part of the data does not change the statistic significantly. There is no rule about what a good data sample size is. Generally, the more the better. Tests run over long periods will cover more market states. Tests run with more markets are more likely to include markets in various states of volatility and trendiness. Do not optimize for only one market. Test how many times a particular rule affected the result. If one rule makes a difference being executed for only a small number of times, there is no solid evidence the rule works. To measure how sensitive the result is to start and stop dates, one can use a rolling optimization window. For example, you select data from 1990 to 2000, and you perform optimization. Then you increase the start and end dates by 2 years, from 1992 to 2002, comparing the performance difference. Repeat this process until you reach the current time frame. Selecting a few parameters and change it by considerable amount could give you some ideas of what the real market performance would be. To summarize, you need to treat with an edge, manage risk, be consistent, and keep it simple. Build your own system, carefully choose markets, design position size, entry, stop, and exit. Then test your system with historical data. Understand cognitive bias. Don't trade with ego, and be friend with risk. Thanks guys for watching, and please let me know what you think about this video in the comments below. I'll see you in another time.